Hello and welcome. In this lecture video, I'm going to talk about budgeting in a merchandising company, and then we'll also do an example problem with an example merchandising budget problem, and then we'll have some concluding comments on budgeting. Okay, so the master budgets between manufacturing and merchandising are pretty similar, but there are some differences. So they could be similar in the sense that they both have a sales budget, for example. They both have a selling and administrative expenses budget. But there are some differences, and one difference, for example, would be that there's no production budget in a merchandising company because they purchased inventory from a supplier, and then they resell it. That's what a merchandising company does. So rather than having a production budget, they have a purchases budget. But the general formula is pretty similar to what we talked about with the production budget, where we say, we need to figure out how much we need to have enough inventory to cover our sales. And then we want to have some ending inventory just in case sales are more than what we anticipated. And then if we have some beginning inventory from last period, we can subtract that to get to how much we actually have to purchase. So if we look at this, the Hockey Den purchases hockey sticks for $60 each, and then wants to have an ending inventory equal to 90% of the next month's budgeted unit sales. On September 30th, they had 900 hockey sticks on hand. So if we look at this is where that 900 hockey sticks comes in, because that was September 30th, which is the end of September, beginning of October. And then we have our month sales right over here, and we want to have 90%, we want to have an ending inventory equal to 90% of the next month's budgeted unit sales. So I can come over here, and this is this month's, and then 90% of next month's, that's the 720. Then I can add in the current sales right over here of 1,000, right? 1,000 plus that 720 equals our 1,720. Take our 800 times the 0.9 gives us our 720 right over here. The 720 plus the 1,000 gives us our 1,720. And then we had our beginning of 900. And then that says this is how much we have to purchase. The 1,720 minus the 900 gives us how many units we have to purchase from our supplier. And then our cost that we have to pay our supplier is $60. And then this is the budgeted cost of our purchases. Same thing over here. We have our budgeted ending units right over here. That was how we calculated that 800, which is next month's. The 800 times 0.9 gives me the 720. That 720, of course, becomes beginning. This is ending for October. That becomes beginning for November. Ending for November becomes beginning for December. Okay? So this is an example purchases budget, which we would use in a merchandising sense rather than a production budget. Okay? Production budget is for a manufacturing company. A purchases budget is for a merchandising company. Let's look at an additional problem for a merchandising company. Our Ben Gordon company distributes a single product that sells for $25. Ben Gordon pays $15 to buy the product and then a $2 commission for each unit sold. Additionally, Ben Gordon has $150,000 in fixed selling and admin, including $20,000 in depreciation. It's Ben Gordon's policy to maintain an inventory at the end of each month equal to 30% of the next month's projected cost of sales. Ben Gordon makes all sales on credit and collects them 20% in the month of sale and then 80% in the month after the sale. Okay? All selling and admin expenses are paid for in the month after they are incurred. Purchases are paid 70% in the month of purchase and 30% in the month after the purchase. Here's our sales budget right over here. Okay? So we're going to prepare a schedule of cash receipts, and then how much cash did Ben Gordon actually collect in April? What amount will they pay for selling and admin expenses in April? Prepare a purchases budget. Okay. and then also prepare an income statement. All right. So let's look at our first one right over here. Prepare the schedule of cash receipts. How much cash did Ben Gordon collect collect in April, and then what is accounts receivable at the end of April? Okay. So let's go ahead. I'm going to put this on a separate sheet of paper. And what I'm going to do is I'm going to write January, February, March, then April, and then May. And then I'll put in my January sales, and then Feb sales, March sales, and then April sales. And I'll just stop there because I'm just doing it for April. Okay, so I'm just going to do it through April. So if we look at January sales, we had the 20,000 units right over here in February, so on and so forth. The first thing that I'm going to do is multiply all these units times my selling price, 25, just to make life a little bit easier. Okay, so $25 times the unit sales, because then that gives me my sales dollars. 500,000 right over there. For January, 600,000 for February, 700,000 for March, 625 for April, and then for May we have our 475. Okay? And so then what we can do is we can come over here and we can say January sales collected in January. Well, if we look over here, Ben Gordon makes all sales on credit, collects 20% in the month of sale, and then 80% in the month after the sale. So 20% of the 500,000 gives us the 100,000 right over here. So January sales collected in January is 100,000, and then January sales collected in February is 400,000. Okay? So what I want you to do is I want you to complete the rest of this schedule through May, all right, through May, and then tell me in April the amount of cash collected. Okay, tell me in April the amount of cash collected. All right, so I'm going to pause the lecture video. I want you to pause the lecture video and then complete the schedule of cash receipts. Okay, then we'll check it together. Okay, so let's see how you did. So we have our total cash collected for April. It's $685. And then our accounts receivable balance at the end of April is $500,000. And you can see that's April sales collected in May. So that's how much of April sales we did not collect at the end of April, which is the accounts receivable balance. And that's $500,000. You could also get that by taking the sales for April of 625,000, which is right here, times 0.8, because that's how much you collect in the next month. All right. So what I want you to do is I want you to go ahead and do number 2, and then we're going to check it. I want to see if you can't do that. Okay. So pause the lecture video, do number 2, and then we're going to check it. Okay. So let's see how you did. So the tricky part about number 2 is it says right over here, all selling and admin expenses are paid for in the month after they are incurred. So what are we paying for in March? We're paying for April selling and admin expenses. Those selling and admin expenses that were incurred in April, we pay for in March. And it says we have our $2 commission, we have our $150,000, and then we have our $20,000 in depreciation. So we take our $24,000 times the $2, gives it, this is our variable, plus our fixed of $150, but we're talking about cash outflows, so we subtract out the depreciation to get down to $178. That is the correct answer, okay? So what I want you to do now is, following this example right up here, I want you to do a purchases budget and tell me what will purchases be for February. So give it a try. pause the lecture video and then let's check your work. Okay, so let's see how you did. So you have your January sales at 20,000, your desired ending inventory. Take that percentage given to us in the problem times 24,000. That gives us the 7,200. Total needs 27,200 units. We have 0 beginning inventory. We weren't given a beginning inventory, so we're just assuming 0. That means we need to purchase 27,200. Okay. We look over here with February sales, and then we take our percentage given to us times the 28,000. This is our percentage desired ending inventory given to us in the problem, times 28,000 gives us the 8,400. Add the 2, 32,400. Ending for January becomes beginning for February, 25,200, and then I multiply that times 15, which is the cost per unit that we have to pay. The cost per unit that we have to pay is $378,000 right there. Okay? That's $378,000. So you should have gotten the 25,200 and then the 15, then that gives you the $378,000. I apologize for that Microsoft warning asking me to reboot my computer. Sorry about that. With number 4, I want you to do number 4, which is asking you to calculate what net income will be in January. And to do that, I want you to use the contribution income statement format with sales minus your variable expenses gives you contribution margin, minus your fixed expenses gives you your net operating income. Go ahead and give it a try, and then we'll review that, okay? Hello and welcome back. So you have your sales. You should have gotten $500,000, the 20,000 times the $25 per unit. Variable expenses, the 20,000 times the 15, which is the cost per unit you purchased from the supplier, plus the variable expenses per unit of $2 gives you $340. You subtract those two, you get contribution margin of $160. You subtract out the fixed expenses. This does include depreciation. You should have gotten net operating income equal to $10,000 right there. Okay. So that concludes our merchandising problem. Now I have a few additional points on budgetary control. As we've talked about before, budgets are frequently used as a standard for evaluation. You will, if you ever go become a financial analyst or an accountant, you'll be doing a lot of this, investigating budget variances. That's something that I had to do quite extensively in my job. We would have variances between what we actually did and then the budgeted, and then also something called outlook. And I would have to spend a lot of time figuring out why did we have these variances, okay? In terms of investigating budget variances, I'm just kind of skipping and hitting the highlights over here. The budget may not have been well conceived. You could have had some conditions that changed. Maybe there's a recession that nobody was forecasting and that came in, and that could be why you had some unfavorable variances. The thing that we're really trying to determine is how well did managers do. That's what we're really trying to figure out. The other thing that we want to figure out is focus on is this idea of management by exception. We only want to look at significant variances. So if you have a 50-cent variance, it's probably not worth your time to go through and figure out what that variance is. Now, it's been my experience in the corporate world that when the company is doing well, sales are strong, profit is good, this term, exceptional, becomes a pretty big number. So yeah, we're off by $1 million. No big deal. We still made our numbers. But when the company is not doing well, every unfavorable variance is going to be scrutinized. Okay. So when we talk about some conflict in planning and control, so budgets are obviously going to be used in planning and control. And I commented on this in the first lecture video. They're highly political, which basically refers to everybody trying to guard their own turf. It's turf protection. They don't want their division to lose their own money. They don't want their division to lose out on future opportunities. You can also have situations where people may try to play some budget games. They may pad the budget, for example. All right. They may shift income to other years to improve their own, to make sure they get their bonus for their year. Or if they're just a cost center, such as a cafeteria, they may overstate their costs. Okay, so they play a bunch of games. That concludes this lecture. Thanks.